Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Currencies and equities both were a sea of red yesterday. We saw another bout of dollar strength with major currencies losing out, yen boldly entering the levels of previous central bank intervention. And when it comes to the US equities, it wasn't a pleasant day either. Not just for US equities, but even for our own domestic equities. Now, ECB meeting is in sight and markets will be keenly looking out for the decision as well as the press conference. JK, what's your expectation from today's ECB meeting and what are the things to look out for?
Good morning, Swaraj. Yes, we are starting that period of the week when a lot of volatility and a lot of central bank actions are expected and more data as well. Let's focus on the yields, which are really the main driver of the markets of late. After falling about 20 basis points on the Monday's trade, the yields have again started to climb, and they started climbing in Asian trade, etc. It's yesterday when the CPI data from Australia came much hotter than expected. Then Bank of Canada held the rate steady, but warned of there could be more, inflation rise in the coming months, and there could be rate rises as well. At the same time, economy could also slow down. So the usual factor of economic prospects which guide the yields and the supply factor has been much bigger in this cycle. At the same time, demand has been far less. There was a hefty issuance of 52 billion by the Treasury of 5-year paper, which received a lukewarm response. And there will be another auction of 38 billion 7-year note by Treasury today, which will not help the bond bull. So once again, we are seeing the 30-year trade at closer to 5.10, and the key 10-year benchmark yield is much closer to 5%, once again recovering much of its losses that we saw on Monday. And not helping the sentiment was also the mortgage rates in the US. The 30-year mortgage rates rose 20 basis points in October to in the latest reading, which is the last seen in October, 20 week, 20 last 20 weeks high. And it's also the 30-year mortgage rate, which is the highest in September 2000 as well. So let me read it again. The average 30-year mortgage rate rose 20 basis points in October, and it is at 2000 September high. So that is also not helping the matters, and the yields are also going up further. The new home sales surprising with a 12.3% jump in September was once again a positive surprise for the market. Then market is already preparing for a hot GDP number today, which can come in the region of 4.3%. So all in all, less demand, more supply, and hot economy, all these driving the yields and the dollar also higher. On the contrary, we have had, of course, the PMI data from Europe, which was much weaker than expected, and then anticipation that Eurozone will get into a flat growth, and perhaps Germany get into another quarter of recession. These are driving the euro lower, and the fall in euro by nearly 1% since the high on Monday evening, actually, or rather on Tuesday, leading dollar index to cross 106.50 and reaching the strong resistance zone. Now, move from here on depends on the yields, of course, and the yields are not showing any chances of a sustainable retreat. Now, we did see a slight improvement in the IFO survey from Germany, and expectation index touching 84.7 in October. But market is still not looking at that, and they are seeing the bigger picture of slowdown. And the European Central Bank, which meets today, is definitely going to go on a pause, and the expectations are increasing that they will be sounding dovish on rate outlook as well as on growth. And now that the inflation is also seen continuously moderating, I think their dovish approach would be well anticipated as well. Now, On the oil, prices settled about 2% higher on Wednesday on worries about conflict in the Middle East. But gains were also capped by higher US inventories. But Israel saying that they are preparing for a ground invasion of Gaza, but holding back because of the relief supplies that were on the way, is also keeping the markets on the edge. So as I said, the dollar index hit a high of 106.62, mainly because of the fall in the euro. But interesting point is the dollar yen, which broke 150 mark and sustaining there. It's trading at 150.40 amid the earlier fears of intervention, which seems to be now fading away. BOJ officials, of course, have said in the past that if the currency moves are orderly and in line with the fundamentals, they are aligned, and that is how the yen is behaving right now. We are seeing a gradual move up in the USD yen, and we are also seeing the differential between US and Japanese yields widening, and no logic demands that dollar yen should be sold, except for the level with which the Bank of Japan might be slightly concerned. So that's giving the bulls some added charge, and we are seeing them pushing the dollar yen higher towards 151.95 once again. Commodity currencies have also weakened on expectation of slower growth, and Australian dollar, which actually rose nearly 1% yesterday after the hot CPI number, has fallen much more on the expectation of the slower growth in the global economy. Now we have had the stocks which took a big beating yesterday, particularly the Nasdaq falling 2.3%, Google shares falling 10% after much weaker than expected results, and it offset the better number that was given by Microsoft. Now, what we are seeing is that there has been a 10% drop in the S&P 500 from the peak that was seen this year, and it is testing the key 100-week moving average. And it's already trading below 200-day moving average. So that's a very significant technical development that the traders and investors would be watching out for. And we have, of course, the ECB meeting today, which is key. Then GDP number, also pending home sales, and a bit more of second-tier data from the US, all of which will be very closely looked at. Then what do we see on the rupee? It's at hefty FI outflows of 4,236 crores. So that is about $500 million yesterday was seen from FIs. Rather, that much of selling was seen from FIs on the stocks, and obviously that much of outflows will also be covered. And the dollar rupee, which had seen a drop to almost 83 in offshore trades on Tuesday, has seen a jump up to 83.1819 yesterday. Once again, market demanding and RBI continuing to supply dollars. So that is the theme. But if you look at the Asian currencies pack, it's a tale of three currencies. You see, the USD INR, USD yen, and USD CNH, the Chinese yuan, they are all trading at the highs that were seen in last September, from where there was a big fall. If you consider your rupee against the dollar index is still much weaker, and therefore one would be tempted to say that USD INR is not overvalued. In fact, you need dollar index to move up further to say that rupee may be overvalued. But if you compare the rupee with the Chinese yuan and Japanese, and we are all at the same level that was seen in September last. So 7.38 on the Chinese yuan, 152 on the USD, and if these break for any reason, that's probably going to trigger some relaxation or relenting by our central bank to let the rupee fall, because rupee strengthening further against the Chinese yuan may not be good for our trade deficit, because that will worsen our exports as well as increase our imports in Chinese yuan. So that is something that I am looking at the Chinese yuan move, as well as the Japanese. Of course, Chinese yuan itself is not out of the woods, because as they reported yesterday, there have been hefty outflows from China to the extent of 75 billion in the month of September alone, and the economy is still expected to demand more easing from the central bank, and that will put the Chinese yuan at a more disadvantage compared to the US rates, which are already very high. So all in all, expectation of rupee hinges upon how the key peers perform, and till then we should be respecting this 83 and 83.30 range. Thank you.
Thank you, JK. And as you mentioned, yields have again taken the center stage after correcting on Monday. Yields have again started to climb up. One of the reasons is because of the continuous issuances of bonds we are seeing. Especially yesterday, we had seen 5-year issuances, and I think today we have the 7-year papers being issued. Mortgage rates are rising, but as per the new home sales data in the US, even that is increasing in the month of September. When it comes to Europe, European PMI numbers were much weaker than expected. And contrasting, if we look at the US PMI data, which were released a few days back, it was well in the expansionary territory of 50. So again, a relative economic weakness is what we are observing in Europe. Uh, so today we have the ECB meeting, and somewhat of a dovish approach is expected, considering how the economy is struggling. And Israel's possible ground invasion is keeping markets anxious on the war front. When it comes to rupee, we are seeing a lot of FII outflows, and post a drop till 83 on the offshore market, it has jumped back again to its old 83.20 range. So as JK mentioned, the pairs to look out for would be the Chinese yuan and the Japanese yen. How they perform will also sort of impact how rupee moves. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.